Welcome back. My name is Caleb Preston, and in the last video, we discussed how private real estate loans are created through owner financing and how investors can buy these loans at a discount. We also learned how AFC, as a trustee investment fund, is able to earn between 10 to 12% returns by buying these loans. Now, if you haven't watched our last video called What is Trustee Investing, I encourage you to go back and watch it now. In that previous video, we looked at the basics of what is trustee investing. Now in this video, we'll be comparing single versus pooled trustee investing and looking at the pros and cons of each. By the end of this video, I guarantee you're going to know more about trustee investing than 99% of investors out there. All right, let's jump into it. So I'd like to briefly recap, what is a trust deed? For our purposes, we'll define a trust deed as a privately held real estate note secured by a deed of trust or a mortgage. Now, these notes can either be created through originations, through private lending or hard money lending, or through seller financing. Now, let's go ahead and take a closer look at how an investor buys a single trust deed. So in this example, a private investor is buying a $131,000 note from an existing beneficiary. This is a note that was created when a seller carried back the financing. The seller financed or owner carried the property to their buyer, and in doing so they create a private loan. Now they want to sell that loan for cash, and they're willing to sell it at a discount, which is the opportunity for this specific individual private investor. So in this case, the investor is buying this note that has a balance of $131,000. The note has a face rate of 7% interest, which means it pays $1,350 a month for the next 12 years. Over the course of that 12 years, that 131 pays off entirely. Now, this note is able to be purchased by an investor for $112,000. So in this case, the investor is going to give $112,000 cash to the seller, and in doing so, that investor is going to earn a 10% annual return on their investment. He's able to earn that higher return because he's buying that note at a discount. Now the seller is happy because they'd rather have cash today than that money over the next 12 years based on her situation. All right, so this note is secured by a deed of trust against the property. Now this property is worth $220,000. So if the payer stops making their payments on that $131,000 note, this investor can come in and foreclose and take the property back to make good on their investment. So for this specific part of his portfolio, this investor isn't concerned with whether the stock market's going up or down, whether interest rates are really rising or falling. His main concern is the ability of that payer to make their monthly payments. And he's also concerned about the underlying value of that real estate, making sure that he has sufficient equity to cover his investment. In this example, he's sufficiently protected. He's at 60% loan to value. So this would be a prudent investment in our eyes given the current market conditions, where he's got a 40% margin of equity above and beyond the balance of his note. So let's go ahead and take a quick look at the pros and cons of our example here of single note investing. Now first, let's review the benefits. So single trust deed investments consistently return between an 8 and 12% annual return. So the returns are great. The investor has direct ownership of the note, so they're listed directly as the beneficiary on that note and the trust, beneficiary in the deed of trust and the lender on the note. So they've got direct control. They can potentially earn a much higher return if that note pays off early. So because they invest $112,000 today, that month pays off. If that note pays off 2 months from now, they're going to get paid off $131,000. That's a pretty significant return on their investment. Also, they could potentially have an upside if they do end up foreclosing on an equity-rich note and they take a property back that has a large margin of equity. And then the final benefit is they have control. I mean, they are the lender. They basically walk through the whole process of underwriting it, managing it, taking it through foreclosure if it goes there. So it's a good way for investors to earn a stable income if they have to be or they want to be in control of their investment. Now let's look at some of the downsides of trustee investing. So, single trustee investors are on the hook for a direct loss if that payer goes into default or if they go into bankruptcy. I mean, if for some reason that property gets thrashed out, the value drops to 120,000, an extreme example, then they're going to be potentially losing money on their investment, and that can cause a lot of headache, a lot of stress. It can be a bad situation. That leads us into our second item, in that these direct notes can require a lot of management. I mean, if you've got someone that's a slow payer, it can be a huge hassle to deal with that person. And if a note goes into default, it can take a lot of time, a lot of energy, and it requires cash outlays to pay for a default and foreclosure. So there's a big hassle factor. There can be. There's also direct liability risk. So if someone's owning notes directly, and let's say they have a commercial property that has some kind of oil spill or chemical issue on it, then they could be on the hook with EPA for direct liability if they have to foreclose and take that property back. So there is that direct liability risk. Also, it can be a high concentration in a single asset. Typically, the smallest note balance is around 30,000, and they go up from there. So one investment could represent a pretty big portion of a client's portfolio. And then also, they have very limited liquidity. So the only way that someone can really liquidate their note is hopefully they can encourage their payer to go refinance, which is a long shot, or they can sell that note to another investor, but once again, it'll be sold at a discount. So maybe kind of a wash when they end up selling that note. There's no guarantee of either. So those are the downsides of it. Just in summary of single trustee investing, we only recommend someone consider single trustee investing if they have a significant amount of experience already in real estate investing, either with other trustees or rentals or flipping properties, and then also that they need to be definitely accredited investors with a significant margin of capital so they can allocate a portion, and it's not going to be a big hit if one of these notes goes into default. So that's a quick summary of single trustee investing. Now let's go ahead and look at what we do here at Alaska Financial and some of the benefits of pooled trustee investing. My family got into note brokering back in '89, and since then we have brokered or purchased over 2,600 of these privately held trust deeds, and the majority of those have been notes that we've sold off to individual private investors, to single investors that are buying these notes directly. Now, how did they get into this business, you might ask? Well, they were going to school up at Fairbanks, Alaska back in '89, and they saw a local seminar on the discounted note business. So they went to the seminar and they learned the same information that you're learning here today. They decided to try it out, and they ended up brokering their first note to a local private investor up in Fairbanks, and McKinley Mortgage was started out of their college dorm. My parents dropped out of school and started brokering notes full time, and the rest is history. So fast forward to '98, and McKinley Mortgage is now the largest note buyer in the state of Alaska. And that year alone, we brokered over 330 notes to individual private investors. Jump ahead to 2005, and by now multiple McKinley Mortgage investors have approached my family about managing notes on their behalf. While notes do offer an exceptional return, they can take a lot of work to manage and can be a big hassle, especially if a payer goes into default. So in 2005, we established Alaska Financial Company as a way for investors to get into note investing without the hassles or the risks of holding notes directly. Today we have a team of 18 that's working for you because we are owned by our investors, and our companies with McKinley and AFC have paid investors over $100 million in interest income from these first trust deeds. AFC operates on the same principle as a mutual fund. It's a pool of real estate notes owned by a group of investors. While we still own McKinley Mortgage, we've found that it's easier to help investors earn stable income through a fund rather than by brokering individual notes. As we've discussed, managing notes can be a ton of work, and most investors simply don't have the time or the expertise to do it safely. So with AFC, we manage the portfolio and take care of the hassles so you don't have to. You get to sit back and we do the work, so we both make money. Now, we grow by bringing new investors into the fund, which is your opportunity here today. Currently, there are 4 ways that you can invest into Alaska Financial Company. Each debenture is a 5-year term, and the funds are locked up from 6 months to 3 years, depending on the series of investment. Our minimum investment starts at $25,000, and the fixed yields range from 6 up to 8.25 annual returns. Now, we don't charge you any fees because we make our money by paying you 6 to 8% and buying notes that generate 10 to 12%. So all of our investors are issued a secured note that is backed by a security agreement. That means that instead of investing into a single note, you have a secured note issued by Alaska Financial Company that's backed by all the assets of the fund, which is primarily a pool of these first trust deeds. Several additional key points here are that our disbursements are paid quarterly as opposed to monthly. You can let your interest be compounded every quarter back into your note if you don't want to receive a cash distribution. And the third benefit is we are set up to receive investments from qualified accounts. So IRAs, SEP, Simple. We have a number of custodians we're approved with, including TD Ameritrade, that we can receive investments from. Now let's look briefly here at the advantages of pooled investing versus single. So the first advantage of pooled trust deed investing is that it offers diversity from a pool of real estate notes. So instead of just holding one note, which could go into default, investors are backed by a pool of anywhere from 200 to 250 notes, so that if one of those goes into default, it's not as big of a deal. There's other cash flow from the other notes that continues to provide that yield without any hiccup or hitch. So diversity is one of the biggest single advantages of pooled trust deed investing versus single. The second advantage is that unlike single note investing, AFC takes on the direct risk of default. So, if someone's going to hold a note as an individual, as a single investor, then they're on the line for losing that cash flow, outlaying the costs, and spending their time to take that note back through default, foreclosure, into recovery. Well, with the pooled investing, our team manages that on behalf of our investors. So we pay all the cash outlays to get a note recovered, and we do all the work. So we take that direct risk of default. If AFC is structured in a little bit of a unique way, we get the upside return above and beyond what we pay you, but we also take the downside risk. So if we lose money on a foreclosure, that comes out of our net operating revenue, not out of your yield. The third benefit is that you can rely on the experience of our team. So we have a team that's we've been started this with McKinley back in '89, so 25 years experience with our family. Our combined management team's experience is over 90 years in this niche. So we've made our share of mistakes over the years. We've learned a lot of lessons. We've been able to systematize the best practice into the operating procedures of our fund. So you don't have to spend any time managing your notes or outlaying any cash. You can rely on our team's experience to go ahead and do it for you. And finally, the pooled investing offers increased access to funds. So it still is an illiquid investment, but there's the ability to pay back investors based on the net revenue of the company, the loan payoffs, the new investment coming in. So there's excess cash on hand to go ahead and distribute back to investors if they have a redemption request. Now you want to take a look at the prospectus for full details on the redemption policy, but there's much greater access to funds versus single trust deed investing. All right, let's briefly look at who is a good fit for AFC. AFC is likely for you if you don't want to lose sleep over your investments, if you want boring, stable income, if you're excited about a 6 to 8.25% return, if you're tired of stock market volatility or the uncertainty of what the Fed's doing, if you're tired of dismal bond returns, and finally, if you qualify as an accredited investor. So AFC3 is only open to accredited investors. So if you're an individual, that means you have to make either $200,000 a year as an individual or $300,000 joint with your spouse, or you have a $1 million net worth, excluding the value of your home. If you're going to invest via corporation, they have to have $5 million plus in assets. And we do have to verify you are accredited upon investment. All right, AFC is likely not for you if you've got to be in control of your investments, if you're afraid to take a little risk, if you're happy with what you already have, or if you do not qualify as an accredited investor. Okay, so if AFC is a fit for you, here's what to do. As a next step, go ahead and click on that button down at the bottom of the home page that says Take Assessment. And what that'll do is that'll lead you into a screen that gives you a securities disclosure. Go ahead and acknowledge that, and then that'll take you into a page where you can enter information about yourself and about some of your investing goals. Go ahead and click Submit at the bottom of that page. And what that'll do is that'll send me or my team a notification. We'll give you a follow-up call. We'll set a time that works good for both of us, and then we'll set a 30-minute phone meeting with yourself and either myself or one of the other officers here at the company to go ahead and find out a little more about your situation, help answer questions that you have, and just see if we're a good fit for each other. If we are, then we'll give you access to our prospectus, our investment paperwork, and help you start earning stable income from a pool of quality First Trust deeds. Well, thank you very much for the opportunity here today. I thank you for taking the time out to watch these videos. Please reach out to us if you have any questions at all. And once again, if you have an interest in learning more about how AFC can help you earn stable income, please go ahead and click on that Take Assessment button here below. Thank you very much.